What is going on, you guys? Welcome back to Mocha Millionaire, the show where we drink coffee and talk about money. Today I have a very special mug with an S on it. I don't know what that means. Super smart, maybe. But today I want to talk about the 4 different ways that rental properties generate income over and above the normal just rent income that most people think of when they think of rental properties. So the first stream of income that rental properties produce is obviously the rental income and the cash flow associated with that. So cash flow is basically everything, after everything has been paid for, cash flow is the money you put in your pocket at the end of the month. So it's different than net operating income, which is just revenue minus expenses, because the net operating income isn't taking into account any debt service. So it's different than that. So cash flow is just what you put in your pocket at the end of the month. And that is the first income stream and the one that is most commonly associated when people think of rental properties. The second income stream is principal pay down that is associated with obtaining a mortgage on a rental property. There are many benefits to obtaining a mortgage on a rental property. There are also benefits to buying properties in cash. However, for the most part, here's my dog. Woo! For the most part, people buy rental properties with mortgages on them because debt is cheap, especially right now. And then, what's up, Danny boy? Debt is really cheap right now, and so people buy properties with mortgages because it allows them to buy more property and in the long run take more advantage of this cheap debt and make more cash flow. So when you get a mortgage on a property and you're collecting rent, you're paying the expenses, you're holding on to that property, and you're paying the mortgage every single month, a portion of your mortgage payment goes towards paying down the principal balance of the loan, which is directly translating into equity in the home. And so this isn't a income stream per se. However, it's generating wealth for you and it's increasing your net worth every single month, even though you don't see it until you either refinance or you sell the property. But it is there and it is very real. So that is something that most people overlook when they think of investing in rental properties. Income stream number 3 is appreciation. Now, this one is up for a matter of opinion, as if this is should be considered a real income stream or not, because appreciation is not guaranteed. However, the longer you hold a property, the better chance you have of being a benefactor of appreciation, because in the long run, housing prices tend to go up. And at a minimum, they should keep pace with inflation. So at the very least, it is an inflation-preserving asset. So basically, when you hold a rental property, your tenants who are paying rent are paying down your mortgage while you are holding an asset that is going up in value. So you start to get this spread that gets larger and larger the longer you hold it. And that is one of the 10th or 11th wonders of the world, is just how much equity you can end up with after many years of owning a rental property. The fourth stream of income is one that most people don't know about, and it's one of the most overlooked ones, but it's the tax benefits that are associated with owning rental property. So imagine you make $50,000 in a year and you own an investment property. You make $50,000 from your job, I should say. What happens when you own rental property is the IRS tax code. Now, disclaimer, I am not an accountant, I am not an attorney. Please consult all appropriate professionals before doing anything. This is not financial advice, this is not tax advice. So when you own a rental property, the IRS tax code allows you to take depreciation on that property. So basically, on paper, on your tax returns, you are allowed to depreciate the value of that asset in residential over 27 and a half years. Over commercial, it's 39 years. However, when most people think of rental properties, they think of houses, so we're just going to stick to residential. So imagine you paid $100,000 for a house. You can depreciate the value of that over 27 and a half years, so that comes out to something like a little less than $4,000 a year. So that $4,000 of depreciation is what you subtract from your taxable income, and then you are not paying taxes on or you're paying taxes on about a little less than $4,000 less than what you actually made. And then other tax benefits associated with it is every single expense you have for this property taxes, mortgage interest, any other utilities, pretty much anything associated with this property is able to be tax deducted. So you get a lot of tax deductions, and then depreciation is a really big one in terms of saving yourself money when it comes to paying taxes. So these are the 4 ways that rental properties generate income. If you enjoy content like this, if you want to see more in-depth stuff, I love going over different investments. I love looking at the numbers on different properties. So either subscribe or give me a comment on what you want me to do next. Thank you for watching.